Hello, this is the ActivTrades Weekly Outlook. Every Monday we analyze the economic calendar and identify key events, focusing on how they may impact the markets. Stay with us over the next few minutes while I look into how the week is likely to unfold. I will cover a range of topics, including the Eurozone's inflation data, Bank of England monetary policy report, and the big one, US non-farm payrolls. We'll start this week's analysis by checking out the publication of Eurozone inflation data on Tuesday, with both core and wider consumer prices coming under the spotlight. The consensus is for a yearly rise of 1.9%, just under the ECB's 2% target. However, global inflation data has been surprising to the upside recently, as economies start coming back to life. So, a higher number here wouldn't be at all shocking. ECB officials have been preempting the impact that positive economic data may have on investors' expectations, repeating a message very similar to the Fed's, highlighting that any spikes in consumer prices are unlikely to extend beyond the near term and that a return to lower levels is likely over the next year. Recent Eurozone data has shown that the region's economy is building momentum as it recovers from the pandemic, so it is possible that numbers will beat the consensus. In such scenario, the euro would be likely to gain ground over other currencies, with the likelihood of earlier tapering increasing. Moving across the British Channel, we get to the UK, where on Thursday the Bank of England will publish its latest monetary policy report, and Andrew Bailey, the governor, will give a speech. No major surprises are expected, but investors will surely be listening with attention. Early this month, Bailey spoke to the House of Lords Economic Affairs, stating that the bank would not tolerate a persistent overshoot in inflation from its 2% target. But he also said that so far there's been little evidence of it happening. As the saying goes, the devil is in the detail, and any hint of further inflation-related concerns could offer support to the pound. Sterling is so far this year one of the star performers amongst G7 currencies, following the end of the political uncertainty surrounding Brexit, the success of the country's vaccination program, and the string of economic indicators giving account of a robust recovery. So, there is no doubt that any signs of hawkishness from the central bank will further support the pound, with the next resistance level sitting around the $1.425 level. To end the week, on Friday, we'll have June's non-farm payrolls to look forward to. The US monthly jobs report, considered the most important indicator for forex traders, will be even more noticeable this month, as it could be the final straw that breaks the back of the Fed's unwillingness to deviate from its current dovish stance. As we all know, fears of inflation have been dominating the narrative in the markets, with the Federal Reserve playing something akin to a game of chicken by insisting that the recent spikes in consumer prices are nothing more than a near-term issue and that bringing forward the timing of the tapering could damage the economic recovery. So, after last month's figures, which disappointed to the downside and to some extent validated the central bank's stance, a strong number in June would provide more ammunition for those who advocate that time has come to start thinking about hiking rates. In such scenario, the dollar index may recover at least some of the ground lost over the last 2 months, and potentially even test new maximums for the year, around the 93.5 level. This is all for today. I will be back next Monday for another weekly preview. In the meantime, please go to ActivTrades.com for more market analysis. Do subscribe to our channel so we can keep you updated with the latest in the markets, and don't forget to click the like button if you enjoyed the video. Thank you very much for watching.